How can you reduce your taxes in retirement? There's not a ton of choices. I'm going to give you a few examples, things to think about, that and more. Coming up. My name is Mike Bernardo, the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. There's 6 areas to everyone's financial life: your financial life, my financial life, Warren Buffett's financial life, all of ours. And one of those areas is tax planning. Tax planning, not tax preparation. Tax preparation is reactive. It's getting the right number from last year in the right box and making sure you're compliant with the IRS. Tax planning is proactive. What opportunities exist for you to pay the least amount of tax over your lifetime, if not multiple lifetimes? Oftentimes that means this year. Sometimes we might say, no, do a Roth conversion, contribute to a Roth, which would mean you actually pay a little bit more this year, but you're going to pay less tax over your lifetime. So tax planning, all about identifying opportunities to pay the least amount of tax over your lifetime. Well, then how do you know if you should implement it? Well, that's where you've got to look at all the other areas of your financial life to see, well, if I do a Roth conversion, or if I do a qualified charitable distribution, does that bring synergy to the other areas of my financial life? What decisions actually have all 6 areas of my financial life really in sync, working together? Those are the opportunities that you want to capture. So in doing tax planning, in doing this comprehensive financial planning, as we help people with the biggest financial decision and financial transition in their life, which is typically leaving the workforce and entering into retirement, what are some of the options or opportunities that you have to pay less taxes in retirement? Well, I saw this article recently, sort of inspired the idea. We do this all day, every day. We love it. We are financial geeks and love helping people creatively figure out how to pay the least amount of tax over their lifetime. So I saw this article and I thought, oh, this is great. And I read through it and I'm like, this is not so great. These are very common examples, and you might say the same about my 3 that I'm going to share with you. But first one is, they said you can contribute to an IRA in retirement, and yes, you can if you have earned income, if you have part-time income. And while many people do have part-time income, well, I would say some people do have part-time income in retirement, it's only going to be for a season, typically a short season. And if it's for a longer season, likely you need those dollars to live on as opposed to saving it into an IRA. So I thought, while that is helpful and that is a way to save taxes in retirement, I don't think it applies to a lot of people. Same with their second idea, contribute to a health savings account. Do you need earned income to contribute to a health savings account? No, you don't. So bingo, could work in retirement, except you need to have a qualifying high deductible health plan and no other health insurance. And for the majority of retirement, I mean the majority, the almost all of it, if not all of it, you're going to be on Medicare, and you can't contribute to an HSA. So the second idea, not too helpful. Does it apply to some? Yes. Early in retirement? Yes. Something you should do. Doesn't apply to most people in retirement. And then the last one was get the extra standard deduction. Automatically, that will happen. Yes, important to be aware of so that you can do creative tax planning. But when you turn age 65, your standard deduction automatically goes up a little bit, just under $2,000 if you're single, around $1,500 if you're married, per person, right? And so that's automatically going to happen. Everyone has a standard deduction, but if you're age 65 or older, you get a little extra. By the way, if you're blind, you get a little extra as well. So those were the 3 ideas the author came up with. Not going to discredit them. Those are fine. They just don't apply to many people. And there you go. There's 3. Hopefully that helps. What about 3 others? Here are 3 tax planning strategies, tax saving strategies that we help a lot of people with in retirement. The first one is doing what's called a qualified charitable distribution. If you're a daily watcher of the Wise Money Show, a fan of the channel, you've heard us talk about this before. It is almost a no-brainer if it applies to you. And yet, the reason we talk about it so frequently is very few people do it. Okay, I'll just say that instead of the double negative. If you can do it, make sure you are doing it. So what's the qualifications? How does a qualified charitable distribution work? Number 1, you've got to be age 70 and a half. And they used the reason why they came up with that age is that used to align with your required minimum distribution, but it's hard coded into the Internal Revenue Code, age 70 and a half. So while they've increased, while they've raised the age for required minimum distribution to 72 and then 73, this qualified charitable distribution age is hard-coded in at 70 and a half. So at age 70 and a half, if you are donating to charities, qualified in 501c3 charities, whether that's church, whether that's a different nonprofit that you care about, or both and, you can do what's called a qualified charitable distribution, transferring money directly from your IRA directly to that charity, and it's not taxable to you. You don't have to worry about, well, now I'm going to have to report that as income on my return, and I'm not itemizing my deduction, so I'm not getting a benefit for the charitable donation, but I care about the cause, or I want to do it, and so therefore, who cares about the tax benefits? I'm doing it anyway. Well, this would be a way for you to donate money, transfer money directly from your IRA, doesn't count for 401ks or 403bs, got to be IRA, to the charity, and in doing so, it's not taxable. That money that comes out is not taxable to you. Even better, once you do reach age 73 and you have to take your required minimum distribution, a qualified charitable distribution counts towards your RMD, your required minimum distribution requirement. So doing so, this can help save you taxes in retirement. Say that your required minimum distribution is 20 grand a year, but you're giving $500 a month to the church. Well, give $500 a month or $6 grand directly out of your IRA, directly to the church. Now your required minimum distribution, that remaining amount, is 14 grand. That's what lands on your tax return. Therefore, voila, tax saving strategy. Second strategy we help a lot of retirees with, at least in this state where we're headquartered, Indiana, is to contribute and help fund their grandkids or child or family members educational expenses. That's right. The 529 plan, they've expanded the use case so that you can actually use it for K through 12 education. You can use it once in your life to help repay student loans. But now, starting this year, you can also use it to transfer excess dollars, with lots of limitations to it, to a Roth IRA. Does your state offer a tax incentive for contributing to the 529 plan? If you're doing comprehensive financial planning, one of those areas is kind of that long-term plan or retirement plan. Another area is estate planning. In doing that, if you've looked and said, you know what, the odds are we're not going to spend all of this money that we've saved up. We've got an ample amount, and therefore there will be some inheritance here. Would it make sense to use some of that inheritance to position it for grandkids' college or for a family member's college and receive a tax benefit in doing so along the way? Here in Indiana, there's a 20% state tax credit in Indiana for your Indiana tax return. So you have to essentially pay Indiana tax for this to be beneficial. But 20% tax credit on the first $7,500 that you contribute. That's a $1,500 tax benefit. And I don't know the tax laws for your state. Maybe it makes sense as a retiree, if you've done that planning and you look and say, yeah, we could afford to do this. This aligns with our values, our goals, and could help you save some taxes along the way by helping to shift some dollars into a 529 plan for your kids, grandkids, or family members. And then finally, the third idea that I'll share with you as a way to reduce your taxes in retirement. I could have started and ended with this one because it is that big. It's an ongoing process, ongoing financial planning process each and every year for many of our clients, and it should be for you as well. And that is to know the limits, pay as little tax as possible on your Social Security, and avoid paying a surcharge on your Medicare. Now that's a mouthful, and that's both and. That's two of those things. But being aware of the calculation that determines or influences how much of your Social Security is taxable. That's right. Whether Social Security is taxable, it depends on your other income. It depends on your financial situation. There's a formula that is done automatically by your CPA or your tax software or whatever. Takes a look at all of your income plus half of your Social Security. Now I'm oversimplifying that, but all of your income plus half of your Social Security, and if that number is above $25,000 for single or above $32,000 married filing jointly, then some of your Social Security starts being included as taxable income. And the higher that number is from that calculation, the more of your Social Security gets added as taxable income. Therefore, the ongoing tax planning work of, well, where are you drawing money from? How much are you drawing out? When a one-time expense comes up, buying a car, a home repair, a big vacation, where do you draw that money from? Having an overall awareness so that you can planfully determine, well, should I take this pre-tax? Should I take it out of the Roth? Should I take it out of the bank account? Should I use some other resources so that I'm paying less or having less of my Social Security come over as taxable? That can save you a considerable amount of tax. And same thing with Medicare. Medicare, this income-related monthly adjustment amount, or IRMA, based on what you pay for Medicare, Part B and Part D, is based on your adjusted gross income, modified adjusted gross income from 2 years ago, the prior year. And therefore, again, a down payment on a new house if you're moving, or buying a new vehicle, or selling, capital gain, selling an asset, something like that. If you have your income all of a sudden spike above those levels and you're not aware of it, it can cause you to pay more for your Medicare Part B and Part D, essentially a tax, versus planning on managing those spikes and avoiding those spikes so that you avoid having to pay that IRMA surcharge. That's another way of avoiding tax or saving tax in retirement. Those are just a handful, just a few of the tax saving strategies you should be considering and working with your CFP on in retirement. So work with your CFP on all that and more. If you don't have a CFP on your team that's doing tax planning, actively doing tax planning with you, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with K. WiseMoneyShow.com. You can find us there as well, or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.